Imagine for a moment the sheer, gut-wrenching dread of watching your financial future evaporate before your very eyes. Picture this. A vibrant, thriving economy surrounds you. Headlines scream about new market highs. Yet, your investment account? It is bleeding. Not just a little, but catastrophically. We are talking about potentially losing 80%, 90%. Perhaps you could even face a total capital wipeout. All this can happen while broader market indices, like the venerable S&P 500, are not just climbing, they are soaring to unprecedented heights. This is not some abstract, hypothetical horror story cooked up in a dystopian financial novel. No, my friend. This is a very real, tangible danger. Too many investors unwittingly invite this danger into their portfolios. They make a fundamental miscalculation. They are betting against a powerful, fundamentally driven market trend. Often they are armed with little more than a hunch and a prayer. And what exactly are the weapons they are wielding in this high-stakes gamble? We are talking about complex instruments like inverse leveraged exchange-traded funds, or ETFs. These also include a host of similar bearish positions. These are tools specifically engineered to deliver profits when the market takes a nosedive. They are designed for a world where stock prices are in free fall. But here is the critical, often devastating catch. What happens when the market absolutely refuses to cooperate? What happens when it is not just resilient, but downright defiant? It can be propelled forward by deep-seated, undeniable strengths. These strengths keep pushing prices higher and higher, day after day, week after week. They make a mockery of every bearish prediction. It is a scenario where the very instruments designed to protect you in a downturn become the agents of your financial undoing in an upswing. For a significant and, frankly, quite exhilarating period now, we have all been witnesses to something truly remarkable in the global equity markets. It has been a story of extraordinary resilience, robust growth, and a relentless upward march. The S&P 500 in particular has become the poster child for this unwavering bullish momentum. It demonstrates a consistent, almost gravity-defying upward trajectory. This is not just a random squiggle on a chart. It is a clear, sustained trend. And what is driving this phenomenal ascent? It is not a mystery, nor is it based on thin air. We are seeing innovation-driven sectors leading the charge. They are acting as powerful engines of economic expansion. Think about the explosive growth in artificial intelligence. Consider the groundbreaking advancements in advanced semiconductor manufacturing. Or ponder the indispensable ubiquity of cloud computing solutions. These are not just buzzwords. They represent tectonic shifts in technology and global demand. They create genuine value and generate astounding profits for the companies at their forefront. They are the bedrock of this market strength. Yet, here is where the plot thickens. A surprising paradox emerges. Despite this abundantly clear, unequivocally bullish momentum, a rather striking number of individual investors find themselves inexplicably drawn to a completely opposite strategy. They are often swayed by an almost primal fear of a market correction. This is a nagging feeling that things have gone up too much, too fast, or simply a deep-seated suspicion that the good times cannot possibly last. These feelings, though understandable on a human level, are dangerous. They are dangerous precisely because they are emotional, not rational. They are feelings, not facts. Driven by these anxieties, these investors are doing something quite astonishing. They are piling into inverse positions. Essentially, they are shorting the very market that is showcasing such impressive, undeniable robustness. It is like standing in front of a speeding train and betting it will suddenly reverse course. This happens even as it gathers more and more speed. They are actively betting against the fundamental drivers of growth. They are fighting the very currents that are carrying others to prosperity. This brings us to the absolutely crucial questions that form the very core of our discussion today. Why, in an environment of such clear strength and compelling data, are so many smart, capable individuals making these incredibly high-stakes, fundamentally baseless bets against an ascendant, powerful market? What compels them to swim so forcefully against such a strong tide? And critically, what vital data points, what undeniable economic truths, what long-term perspectives are they either completely overlooking, or, perhaps even more concerningly, are they actively choosing to ignore them? Are they instead favoring a narrative fueled by fear or a mistaken sense of market intuition? These are not trivial questions. They are the difference between building lasting wealth and suffering devastating, avoidable losses. This is especially true when the market's underlying foundations appear so sturdy. That is precisely where we must direct our focus now. Let us dissect the mechanism of this disconnect. We will begin with what I believe is the most pervasive, yet fundamentally flawed reasoning behind these dangerous bets. It is the seductive, almost intuitive, but ultimately baseless logic that says it has gone up too much, too fast, therefore it has to come down. This is not an investment thesis, it is an emotional reflex. It is the feeling of vertigo when you look down from a great height, not a reasoned calculation based on gravity and physics. Investing, especially when you are committing your hard-earned capital, is not about gut feelings. It is not about market intuition. Nor is it a vague sense that the universe demands a correction simply because something has performed well. It demands concrete, verifiable evidence. Think of it this way. A rocket, powered by immense thrust, continues to accelerate upwards. Would you argue, purely because it is high, that it must fall? No. You would examine its engines, its fuel, its trajectory. You would consider the laws of physics that govern its flight. In the market's context, where are the fundamental indicators that genuinely signal an imminent, sustained market downturn? Where is the incontrovertible proof of deteriorating corporate earnings? Where is the emergence of systemic economic cracks? What about undeniable, widespread shifts in consumer behavior that would actually justify such a sentiment? We are not talking about a temporary pullback, a minor consolidation, or a couple of volatile trading days. Those are normal fluctuations in any healthy market. We are looking for foundational shifts. We need a significant, enduring reversal of the underlying forces that power growth. Without that, simply declaring the market too high is akin to wishing a healthy person sick. It is a dangerous gamble. It is often made in the absence of any real data-driven reason. So if we are not relying on feelings, what should we be relying on? Let us pivot to the absolute bedrock of stock market performance: corporate earnings. This is where the rubber meets the road. It is the fundamental truth that underpins all long-term value creation. When we examine the aggregate earnings per share for the S&P 500, it is not showing signs of faltering, peaking, or entering a period of decline. On the contrary, it is on what I can only describe as a clear, straight-up, high-kick trajectory. It is consistently rising. It demonstrates robust health across a broad spectrum of American corporations. Companies are not just meeting, they are often exceeding profitability expectations. They are providing positive future guidance. They project continued growth in their respective markets. This is not a mirage. It is a tangible reflection of corporate health and economic vitality. It fundamentally justifies higher valuations. Consider the immense capital that drives global markets. We are talking about global institutional investors. These include massive pension funds, sovereign wealth funds, hedge funds, and mutual funds. They collectively account for the lion's share of market capital and trading volume. These are not individual investors making impulsive decisions based on a tweet or a hunch. These are sophisticated entities. They have armies of analysts, economists, and data scientists. They perform exhaustive due diligence. They are not buying based on hype or a vague feeling. They are deploying trillions of dollars because they see robust, accelerating earnings growth. They see the data, they analyze the forecasts, they conclude that the underlying businesses are performing exceptionally well. This warrants continued investment. To bet against the market when these titans of finance are pouring capital into it based on a clear earnings picture is to effectively bet against overwhelming, professional, data-driven conviction. Now, let us zoom in further. Let us consider the specific sectors that are currently acting as the undeniable engines of this market strength. We are not talking about generalized, amorphous growth. We are talking about targeted, innovation-driven expansion. Think about the infrastructure being built for artificial intelligence. Consider the cutting-edge processes in advanced semiconductor manufacturing. This includes particularly chips like high bandwidth memory, or HBM chips, which are crucial for AI processing. Also, think about the relentless expansion of enterprise cloud solutions. Demand for these transformative technologies is not just strong. In many cases, it is insatiable. Leading companies in these spaces are reporting record backlogs. They are aggressively expanding their production capacities. They are laying out clear, multi-year roadmaps for innovation and sustained growth. This is not a speculative bubble based on airy promises or flimsy business models. It is not like some of the internet companies during the dot-com era that had no clear path to profitability. This is a fundamental economic shift. It is driven by genuine, verifiable demand and groundbreaking technological advancement. Artificial intelligence, for instance, is not a fad. It is a foundational technology that is reshaping industries globally. This ranges from healthcare to finance to logistics. The semiconductors powering it are bottlenecks that the industry is furiously working to resolve. This indicates massive, ongoing capital expenditure and strong pricing power. Cloud computing continues to underpin nearly every modern business. Enterprises constantly demand more storage, more processing, and more sophisticated services. How can anyone rationally justify a bearish bet without compelling, data-backed evidence? This evidence would need to fundamentally contradict this underlying, palpable strength. To ignore these facts is to wear blinders in a market. This market is shouting its direction with every earnings report and every new product announcement. And this brings us to the very instruments many are using to wage these ill-advised wars against the market. We are referring to the treacherous nature of inverse leveraged exchange-traded funds, or ETFs. These are not your grandmother's investment vehicles. They can offer quick, amplified profits in a sharp, sustained market downturn. That is their stated purpose. However, their daily rebalancing mechanism works powerfully against you in volatile, flat, or most destructively, upward trending markets. Let me explain this volatility drag or path dependency in simpler terms. An inverse leveraged ETF, for example, a 2x inverse ETF, aims to deliver 200% of the inverse daily performance of its underlying index. The key word here is daily. Every single trading day, the fund rebalances its holdings to achieve this target. Imagine the S&P 500 starts at $100. On day one, the S&P 500 goes up by 10% to $110. Your 2x inverse ETF loses 20%. So if it started at $100, it is now at $80. On day two, the S&P 500 then falls by 10% from its new level of $110. That is an $11 drop. This brings the index back to $99. On this day, your 2 times inverse ETF is supposed to go up by 2 times 10%, or 20% from its value of $80. 20% of $80 is $16. So your ETF is now worth $80 plus $16, which is $96. So after 2 days, the S&P 500 is down by 1%, from $100 to $99. But your 2 times inverse ETF, which was supposed to go up when the market went down, is down by a full 4%. It went from $100 to $96. This happens because the 20% gain on day 2 was applied to a smaller base, $80, rather than the original $100. Over time, especially in a market that goes up and down, but generally trends sideways or slightly upward, this daily rebalancing systematically erodes your capital. It is like trying to fill a bucket with a hole in the bottom. No matter how much water you pour in, some always drains away. This volatility drag means that even if the market essentially goes sideways, oscillating up and down without a clear direction, the decay from rebalancing can erode your capital significantly over time. And if the market relentlessly climbs, as it has been, your losses are not just amplified, they are theoretically infinite, mirroring the risks of direct short selling. Every day the market goes up, your fund loses money. The next day's calculation of your leveraged inverse position is based on an ever-decreasing capital base. This can quickly lead to margin calls. Here, your broker demands more money to cover your mounting losses. Ultimately, if you cannot meet those calls, your account can be completely, quote, zeroed out. You lose your entire investment and potentially more. These instruments are explicitly designed for short-term, highly specific market views, literally for intraday or perhaps a few days trading. They are not for fighting a prolonged bull market. To hold them for weeks or months in an upward trending environment is quite frankly financial self-sabotage. One of the enduring strengths of the United States financial markets, and a significant reason for its global prominence, is its unparalleled transparency. It offers a wealth of publicly available data. We are not operating in the dark here. We have robust earnings per share trends. These are meticulously reported and independently verified. We have detailed analyst consensus price targets. Dozens, sometimes hundreds of professional analysts publish their projections for future stock prices. We get clear forward guidance directly from companies during their earnings calls. They outline their expectations for the coming quarters and years, and we have comprehensive macroeconomic forecasts from institutions. These include the Federal Reserve, the International Monetary Fund, and countless private research firms. This entire ecosystem allows for truly informed, evidence-based investment decisions. These often project clear upward paths for the overall market and specific sectors. While some developing markets around the world may indeed lack this depth of widely disseminated official forecasting and granular corporate data, the core principle remains universal. Prioritize objective data and rigorous analysis over subjective feelings. Avoid unverified narratives or speculative whispers. The availability of this verifiable information in the U.S. market serves as a powerful antidote to fear and conjecture. It enables investors to look past the emotional noise. It allows them to focus on what is tangibly happening in the underlying economy and within corporations. This is not just about backward-looking analysis. It is about using the available data to make intelligent, forward-looking assessments. These are grounded in reality, not wishful thinking or panic. And speaking of forward-looking assessments, a quick, honest glance at history confirms an undeniable truth. This is the long-term upward bias of strong, innovative economies. This is not a new phenomenon. It is a consistent pattern over decades, even centuries. Over the past 30 years, for instance, the S&P 500 has delivered over an 800% return. Even looking at just the last 5 years, it is up over 80%. These are not small incremental gains. These are life-changing returns for those who have invested patiently. They align themselves with the fundamental forces of economic growth and innovation. Why does this long-term upward bias exist? It is driven by human ingenuity. It is fueled by population growth, by productivity improvements, by technological advancement. It also comes from the relentless pursuit of profit and efficiency. Companies constantly innovate, economies adapt, wealth is created. Inverse bets, by their very nature, are almost exclusively short-term, speculative plays. They are often fighting the very long-term trend. This trend consistently rewards patience, disciplined capital allocation, and fundamental investing. When you choose to bet against this powerful, sustained force, you are not just taking on risk. You are often setting yourself up for failure. You are actively working against the tide of prosperity that has historically lifted millions to financial security. It is an uphill battle every single day against the very forces that define economic progress. Beyond the immediate financial losses, consistently betting against the market exacts a heavy psychological toll. This is especially true with highly leveraged instruments. The constant anxiety of watching your bet go wrong can be debilitating. So can the endless stream of what-ifs as your position deteriorates. The gnawing fear of theoretically infinite losses leads to restless nights and significant personal stress. Many who have engaged in sustained short selling or inverse strategies describe vivid dreams of the market surging higher. This is an unsettling, direct reflection of the immense pressure and the burden of that theoretically unlimited loss potential. This is not just about money. It is about your peace of mind, your sleep, your overall well-being. The worst case scenario for an inverse bettor is not just a depleted portfolio. It is a profound emotional drain that can impact every aspect of their life. While some investors are actively losing money fighting the market, others are strategically capitalizing on its inherent strength. The true cost of bearish speculation is not just the capital directly lost through declining inverse positions. It is the profound opportunity cost of not being invested in the leading sectors and companies. These are the ones genuinely driving economic expansion and innovation. Imagine for a moment the sheer gut-wrenching dread of watching your financial future evaporate before your very eyes. This happens not because you made a bad investment, but because you missed out. You missed out on the market potentially reaching 6,000 or even higher. This is a plausible best-case scenario given the current trajectory of innovation and earnings growth. This opportunity cost is a silent killer of wealth. It is a missed journey to financial prosperity. All this happens because of an unfounded bearish stance that flies in the face of strong fundamentals. Conversely, the best case scenario for those who continually bet against the market in an environment like this is often simply that they lose less. They lose less than they otherwise would have had the market surged even more aggressively. It is a lose-lose proposition. A responsible and justifiable bearish stance requires undeniable, concrete evidence. It is not just a hunch, a feeling, or an over-reliance on historical cycles. These cycles may not apply to the current unique economic landscape. We are talking about sustained economic contraction. This could be evidenced by multiple quarters of negative gross domestic product growth. We would need to see a clear and dramatic deterioration in aggregate earnings per share forecasts. This would be across future reporting periods, not just for a single quarter. It would signal a fundamental weakening of corporate profitability. We would look for significant, widespread tightening of global liquidity. This would make it much harder and more expensive for companies to borrow and invest, thus stifling growth. Or perhaps major geopolitical shocks could fundamentally alter the investment landscape. They could disrupt global trade, supply chains, or international relations in a lasting way. These are the kinds of structural, foundational shifts that would provide a legitimate basis for a bearish outlook. We need to see sustained negative trends and structural breakdowns, not merely a day or week of volatility or a period of sideways consolidation. These are often dismissed as a prelude to a crash by perma-bears. Until such compelling, broad-based evidence emerges, the current data overwhelmingly points upward. The worst case for the broader market would indeed be the emergence of these conditions. That would represent the best case for a correctly timed bearish bet. But the key is that the bet must be based on the actual emergence of these dire circumstances. It cannot be merely their anticipation based on a hunch. Instead of attempting to fight the prevailing market tide, which history and current data suggest is a losing battle, savvy investors should be identifying and allocating capital. They should target the top-tier companies. These include the, quote, blue chips, the sector leaders, often referred to as Magnificent Seven or similar groupings. These are the companies demonstrably driving market growth. They have robust balance sheets, consistent earnings, clear competitive advantages, and strong future pipelines of innovation. They are the undeniable engines pulling the market forward. They generate real profits and solve real-world problems. Aligning with them is a far more prudent and potentially profitable strategy than betting against them. This represents the clearer, smarter path for investors seeking to grow their wealth responsibly. It is aligned with verifiable economic progress. In essence, the market is not driven by fleeting sentiment, unsubstantiated fears, or wishful thinking. It is fundamentally propelled by corporate earnings, relentless innovation, and robust global demand. Betting against a fundamentally strong and data-supported market, especially with highly leveraged inverse instruments, is an incredibly high-risk proposition. It has severely limited upside and potentially infinite downside. Before you even consider such a high-stakes bet, pause and ask yourself, what is my concrete, data-backed, verifiable evidence for a sustained, significant market downturn? If your answer is not rooted in solid fundamentals, verifiable economic data, and a clear understanding of the underlying drivers of corporate profitability, then you are speculating, not investing. And in the current market environment, speculation against the prevailing trend is a path fraught with peril and regret. Focus on facts. Embrace the long-term upward bias of strong economies. Allow objective data, not emotional narratives or the siren song of short-term gains from market crashes, to meticulously guide your investment strategy. Your portfolio, and perhaps more importantly, your peace of mind, will ultimately thank you for it.